Welcome everyone to the first discussion in our new series 3 and 3. My name is Jason Weaver. I'm the Managing Director with Weaver Consulting Group, a local registered investment advisory practice in Huntington Beach, California. Today we're going to be discussing 3 topics for our most recent conference call that happens on the third Wednesday of every month: Federal Reserve interest rates, strong dollar, and volatility. Federal Reserve interest rates. The United States has over $21 trillion in debt. Every time interest rates go up by 0.25%, that's the potential to raise debt payments by $50 billion. The Fed has raised interest rates 7 times since 2016, and they're talking about raising interest rates another 4 to 5 times over the next year and a half. From our perspective, the Fed might be on too aggressive of interest rate policy, and they may have to change their tune going into 2019. We've actually seen long-term bonds, 10 and 30-year bonds, peak so far in May of 2018, and they've been coming down. So what's happening then is your bond funds have been performing better over the last couple of months, and they may continue to perform better into 2019. As you can see, after the crash of 2009, the Fed basically held a zero interest rate policy all the way up until 2016 before they actually started raising interest rates. Strong dollar. The United States posted a very strong 4.1% reading in the second quarter. Anytime you get that strong of a reading in an economy, what happens is it has the potential for their currency to appreciate. Since most debt from foreign countries is held in US dollars, that causes actually inflation. Their central banks then raise interest rates to counteract inflation, and that has the potential again to slow their economy. That's especially true for emerging markets. We've seen issues in South America and Turkey. Now would be the time to start looking at your international investments to make sure that they're appropriately diversified. And also maybe take that trip you've been thinking about. As you can see, the dollar since the middle of the year has been on a basic upward trajectory. Volatility. We measure volatility by the VIX. The VIX is a way of looking at the expected fear in the market. The VIX has been rather calm since 2017, but we did get a spike in the January through February correction. It's been coming down ever since. When you're investing and managing portfolios, when the VIX is lower, the cost to insure your portfolio is cheaper. Now might be the time to start looking at insuring certain parts of your portfolio. Thank you for joining us for 3 and 3.